Tarun Mehta, co-founder and CEO of Ather Energy, joining in. Tarun, great to have you on India Market Open. Thank you so much for your time as we do a bit of a recap of the year that's been and what your outlook is as well. Let me start with what the journey has been as a listed company. It's been a few months now, and then, have you gotten used to answering queries every quarter on your balance sheet and going beyond what the broader vision is to the actual numbers?
Thanks for having me here. As an entrepreneur, storytelling is part of the job description, and I think it continues in the public space. I think we very much actually enjoy explaining how things are shaping up, how we see the market every quarter. So we've had an opportunity to do 3 con calls till now, and I think we're getting the hang of it.
Okay, let's talk about the climb up in the market share charts. How crucial is that, and what is the strategy that you have in place and the goal on those charts? Where do you aim to be?
So for us, and we've been guiding it since pretty much since the start of our IPO process, the products were very much there, and the biggest gain for us was going to happen because of store expansion. We've been very disciplined with our network and our store count. Our store count had to expand with the right product portfolio, and with Rista launching last year, we've been able to grow our network substantially. We were at roughly about 250 stores in December, and by the end of Q2, we were at about almost 530, 550 stores. So that store expansion is what's driven really our market share gains. We've seen gains across every single zone: South, West, Central, North India, East India, everywhere. Particularly what I'm very excited about is, obviously, we maintained our leadership in South. In the month of October, we were #1 in every single state across the southern markets. But what's really exciting for us is how the Western and the Central markets have been shaping up for us. So, for example, in Gujarat, we are consistently at about 25% market share. This is a market where it was notoriously hard for us to crack. We were perpetually stuck between 4-5% market share before our family scooter last year, Rista, and now we're at about 25% consistently. Madhya Pradesh has been also a fantastic growth story, and so has been Maharashtra. Now that this belt is delivering great results, we are focusing our attention on expanding our network in a big way in North and East India in the coming months. So we think there is a lot of compounding left. There's a lot of growth opportunities still left. Places where we've been able to go deep, like South, we've seen 25-27% market share. So I think there's a lot of potential in the country right now for us.
That's interesting. So Tarun, morning, Alex here. If you dial back the clock a few years, the positioning that Ather had with regard to the bikes that it sold or scooters that it sold, it was viewed as a little bit of a premium seller of electric two-wheelers. And this in the context of you had lower powered electric vehicles available, and this is something that was more expensive than all of those, right? I'm just wondering whether that profile has shifted and whether you intend to shift it even further. You've spoken about Rista. And so if you were to compare yourself with ICE and the way that people look at entry-level, mass market, etc., and then move up the ranks, how do you see yourself positioning yourself?
Right, Alex. So we've obviously approached the market very differently. We've started from the very top, and we are expanding our addressable market with every passing year. And we believe that's the right way for any new technology. Any new technology should start with early adopters right at the top of the pyramid and then permeate through the levels. I think it's also fantastic for a consumer brand to build a phenomenal amount of love and trust there and then go across the country. Having said that, there is also another thing which is a fundamental thesis for us. We believe in the upgrading story of India. We believe that the Indian consumer is going to move up in prices, which is something we are, by the way, seeing very, very consistently over the last few years. Sales of 125cc scooters have been on a fast track growth within petrol scooters. Within electric, the share of greater than 1 lakh rupee scooters by our reading has been absolutely the highest, almost 70-80% of the market, which is why even as we have expanded our market by launching cheaper models, we've consistently been able to maintain in our observation almost a 15 to 25% premium to most other players. And that premium is what's driving better profitability. That premium is not because we are saying we want to operate in the top sliver of the market. That premium exists because we are saying contrary to many other players, that the market is moving up. Do not try to de-spec the product, maintain your experience. Consumers are upgrading up, and they would, and the opportunity is to be the brand of choice for these players for these buyers in the coming years.
Yeah.
So in a sense, think less as premium, think more as we are betting on the future and the upgradation of our market.
So you've said that you're a good storyteller, and you proved that in the last answer. But I think ultimately your investor is going to pay attention to the numbers, Tarun. And so therefore, the question to you: you've moved from 408 crores of revenue in FY22 to 2,250 in FY25. Currently 1,543 crore. The question is, when do you move to PAT positive? You've seen that trajectory move quite dramatically. Is it going to be in FY27?
Obviously, exact guidance is difficult to give.
Not asking for one.
Right, but you're right. The trajectory has been extremely favorable. In the past, the biggest mover of profitability for us, or the movement towards profitability, has been unit economics. Our unit economics has been improving at a furious pace. Teams have been able to take 6, 7, 8, 9% cost out every year, and that directly shows up in gross margins, which is why our gross margins jumped up from 9% to 19% last year, and are right now, despite subsidy reduction, they're already tracking at 22% plus. And they continue to improve despite a weaker currency and all other factors. But now, with expansion of stores, I believe the short-term driver for the movement towards profitability, and hopefully EBITDA and PAT profitability, will be operating leverage. So our fixed costs are obviously no longer growing very fast, but the volumes are compounding at a very, very good pace. So Q1 we saw 100% growth over Q1 last year. Q2 we saw 60% growth over Q2 last year, and Q3 also, as the Vahan numbers show, has been coming out quite favorably for us. So
Tarun, the short answer to Alex's question: by when are we becoming profitable?
Difficult to say, but I think. I think in the next year or so, I think you will see a very strong...
Next year or so, okay, maybe FY27 then. In that case, might be the year. All right. Thank you, Tarun, for speaking with us.